What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the top 4 companies or stocks that you should consider buying right now in September 2020, and these companies belong to the pharmaceutical industry according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether these 4 stocks either belong in our dividend portfolio or our value portfolio by using this checklist. Make sure that you stay tuned because we'll be going into in detail about the company's financials and the fundamentals behind these. So if you guys feel like being amazing, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without a further ado, let's get this video started. So 4 pharmaceutical stocks with deep pipelines. These pharmaceutical names give you exposure to the CVPD through non-vaccine deployments. By Larry Rammer, Investor Place contributor. I'm very optimistic that we will see a successful vaccine for the novel CVPD launch within a few months. Still, the stocks of smaller vaccine makers have already soared, so they may not be the best pharmaceutical stocks to buy at this point. So far this year, Moderna stock was jumped 220%, BioNTech has rallied 70%, and Novavax has soared incredible 2,500%. Pfizer, Johnson & Johnson, and AstraZeneca haven't climbed too much, but they are gargantuan companies, and Johnson & Johnson and AstraZeneca have vowed not to profit from their vaccine while the pandemic continues. Further, the degree to which the vaccines will work and how long they will keep people immune from the CVPD are uncertain. And what happens if the CVPD disappears more quickly than we expect? Given these points, I think it is probably too late to make big profits from the vaccine makers. As a result, I don't think they are good pharmaceutical stocks to buy. Consequently, I believe that investors are better off buying CVPD plays within the pharma sector other than the vaccine makers. Here are 4 pharmaceutical stocks to buy in this category. Pharmaceutical stocks. West Pharmaceutical, ticker symbol WST. West Pharmaceutical makes stoppers, seals, and syringe components, and most importantly, it also develops custom solutions for injectable drugs. Trading with a market capitalization of $20.8 billion, West is clearly a huge player when it comes to supplying equipment for intravenous drugs. As a result, I'm not surprised that as the company disclosed during the second quarter conference call, the multiple makers of CVPD vaccines are among its customers. On the call, CEO Eric Green said, "We're helping our customers in the selection, testing, and verification of components. We're doing this in a way that prepares our customers for the future commercial scale-up and launch of any successful vaccine candidates. Hundreds of millions, if not billions of people are likely to receive CVPD vaccines, and West is ready to supply much of the equipment to actually inject those vaccines." The fact that West is spending time and money on developing vaccine components indicates that it is confident that it will generate meaningful revenue and profits from the endeavor. Also positive is commentary from Green. On the conference call, he indicated the company was prepared to provide equipment for at least hundreds of millions of doses. The forward price to earnings ratio of 67 times sounds high, but it's actually pretty low for a company set to benefit tremendously from the launch of the CVPD vaccines. Okay, now let's see what the current price to earnings multiple of West Pharmaceutical is. WST. It's around 69.72. Definitely more on the expensive side when compared to the S&P 500 index, which is around 29.46. Okay. Now, in order for a company to meet my dividend portfolio, it basically needs to meet 4 criteria. And these 4 principles or criteria that I like to call them are based on these 3 books, which I highly recommend reading. So the first rule in this principle is that rule number 1, the current free cash flows must be positive, meaning that the company is actually able to bring in positive cash flows when compared to representing money in its income statement. And rule number 2, that the current dividends that is being paid out should not be more than 75% of the current free cash flows, meaning that the company at least has 25% of its free cash flows for the management to invest back into the company or pay off its debt. Rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. So it needs to be growing its dividends over the past 5 years. And if you want to be on the most conservative side, you can consider 10 years or more. And rule number 4 is our buy criteria. We only want to be buying the stock when the current dividend yield is greater than or equal to the 5-year dividend yield average, meaning that the company is currently at a bargain price so that you can have a positive upside in terms of dividend as well as its capital appreciation from this stock price. Now, I like to use Y charts in order to get the data regarding the dividend information. WST, we can see that the revenues have been increasing. Free cash flows have also been increasing. Just for fun, let's see how many times it's doubled. 64 double is 128. 128 double is 256. So around 2 doubles approximately. So around 15 to 20% year over year increase over the past 10 years. So the free cash flows is definitely a positive. Now, the total dividend paid out, it's 45.10 divided by 240.80. So that accounts to around 18%. Just for simplicity, let's assume 20%. So 20% of its free cash flows is being paid out as dividend, meaning that the remaining 80% can be reinvested back into the company. Looking at the dividend curve, we can see that it has been paying out its dividends. Let's see if it has been increasing its dividends over the past 5 years minimum. So looking at this, it has been increasing its dividends over the past 21 years. Definitely meets the criteria for this one as well, and at a rate of somewhere around 7.18%. And now the right time to buy the stock is when the current dividend yield is greater than the 5-year dividend yield average, which is 0.54. Just for the sake of fun of it, I know that we missed our chance, so we cannot buy the stock at this current valuation because we'll be buying it on the top side, meaning that it doesn't have any upside potential at this current time frame for this company. Just for fun, if you were to invest in the company back in March when the dividend yield was around 0.46 or so, or somewhere around, let's have a look, April of 29 when the current dividend yield was around 0.53. Let's see how much the price would have been appreciated. What was this again? It was somewhere around, you can say April. Yep, April of 2019. Of $115, that would have nearly doubled, more than doubled in the span of a year. So more than 100% returns if you had invested in this company back in April of 2019, which is pretty good and pretty advantageous if you were to look at the company at the current valuations or so, right? And since it doesn't meet our dividend portfolio, let's see if it meets our value criteria. In order for a company to meet our value portfolio, it needs to meet 5 rules this time, and these 5 rules are based on these 3 books, which I highly recommend checking it out. Now, the first rule is that the return on invested capital must be greater than or equal to 10%. So we want to be investing in companies that are profitable. So the more higher this percentage is, the more profitable the company is. And rule number 2 is that it needs to have a consistent net cash flows, meaning that we should be able to project the future cash flows to a particular extent 10 years from now, looking at the previous projections and the trend it has been following. And rule number 3 is that it needs to have a strong balance sheet. So we want to be making sure, as a rule of thumb, that the long-term debt on its balance sheet, it should be able to clear it off within 6 years or less than 6 years with its current assets or its free cash flows. And rule number 4 and rule number 5 are buy criteria. So we only want to be buying the stock only when the current price is at least at a 20% markdown from its fair price, that is obtained by 0.8% times the fair price, which we'll be calculating within a few seconds. And rule number 5 is generally considered if rule number 4 isn't met when the current price to earnings ratio is less than the highest 5-year average, 5-year price to earnings ratio, and lesser than the S&P 500 index. Looking at the S&P 500 index, WSD 69.72, it's definitely not lesser than the S&P 500 index. As a result, we know that rule number 5 is out the door instantly. Now, looking at WSD's fundamentals, we can see that the company's price to earnings ratio is 14.12%, which is definitely a positive. And looking at its free cash flows, we know that it's been increasing pretty substantially, and this only accounts to around 20% of its free cash flows that it's paying out. So net free cash flows are good. And looking at its total long-term debt is around $256 million, which it can easily clear off within the coming 12 months if the management does to do so with its $1 billion in its current assets. Now, let's calculate the future value of the stock. So the current earnings per share is $3.79. And it has been trading at a price to earnings multiple of 33.13 as its lowest, and the highest is 75.99. And the analysts are estimating that the company can grow somewhere around 15%. So what we're doing here is we're taking the projections of the earnings 10 years from now and multiplying with the price to earnings ratio. Your job is to implement the minimum and the most conservative price to earnings ratio so that you're not overshooting the company's intrinsic valuation. So looking at the current price to earnings ratio, I would consider 30 because it's the minimum of the analyst estimates, which is multiplied by analyst estimates times 2, or the price to earnings ratio of the 5-year average, which is 54.06. Looking at this, it's around 30 as the price to earnings multiple, and we will get the intrinsic value of $399.98. The fair price at which you should be buying the stock would be $113.70. Considering the 20% markdown, the right time to buy the company would be around $90.96. If you were to look at this and the current valuation of $263.66, it does not meet either our dividend portfolio or value portfolio by using this current metrics. So it does seem to be on the expensive side. We want the company at least to fall below $90 or around that range if you want to buy this company with a suitable margin of safety, that is. Now, let's have a look at the next company. It's GILD Sciences, ticker symbol GILD. In the first month or two after vaccines are ready, only the most vulnerable members of the society are likely to receive doses. Further, some people with weak immune systems may not be able to ever receive vaccines. And of course, particularly if there is a second wave of the virus in the fall and winter, millions of people are likely to have it for at least a couple of months after the vaccines are introduced. Also likely to boost the results of the CVPD treatment makers is stockpiling. Nations will probably collectively buy successful CVPD treatments in case a different strain surfaces. Given all of these points, buying GILD stock definitely makes sense. In a previous article on GILD, I argued that the remdesivir clearly helped moderately ill patients. Specifically, I wrote 1.3% of the patients who received the drug died versus 2% of those who did not receive it, and just 0.25% of the patients who received a remdesivir were on ventilators or an ECMO machine versus 2% of those who did not receive the drugs. Apparently, the US Food and Drug Administration, which is known as the FDA, agreed with me. The agency approved the drug for the treatment of patients with moderate cases. Remdesivir has previously been approved for use in patients with severe cases of the virus. Further, GILD is testing inhaled versions of remdesivir that could be given to patients before they have been admitted to the hospital. As I noted in my previous column, I expect the company to sell $10 billion of remdesivir this year, excluding royalties from generic drug makers. From context, its total 2019 revenue came in around $22.5 billion. As a result, I think that the revenue from remdesivir will ultimately lift GILD stock meaningfully. Okay. GILD currently doesn't have any positive earnings. As a result, it's not showing a positive price to earnings ratio. But let's see if the company doesn't meet our dividend portfolio criteria. Revenues have been increasing. Free cash flows, 3.6, I would say around 10 to 15% year over year increase, looking at the looks of it. And so free cash flow is definitely a positive. The amount of dividend that's being paid out, $3.22 billion divided by 8.319. It's around 38%. So around 40% of the dividends is being paid out. Now let's have a look at GILD dividend history. And it has been paying out dividends over the past 5 years at a rate of 11.05%, which is definitely something to look at. And now let's have a look at GILD stock, GILD. So we can look at the current price to earnings ratio is 3.97%, and which is definitely higher than the average dividend yield of 3.07%. As a result, we can consider buying GILD stock as a part of our dividend portfolio at its current valuation, as it does seems to have some sort of upside potential to it, right? And looking at GILD stock in terms of a value perspective, it has a total of return on invested capital of 11.21%. That's pretty good. And free cash flows are okay, but it hasn't increased that significantly. The strong balance sheet has around $24 billion in long-term debt, which it can easily clear off with its current assets within a single 12 months if the company chooses to do so. Since the earnings per share is negative, we won't be able to calculate the fair price. As a result, we can consider this as in rule number 4 or rule number 5, because it doesn't have a price to earnings ratio to kind of go off by, and it doesn't have a positive earnings for us to project the earnings per share for 10 years from now. As a result, we can consider GILD stock as a buy in terms of a dividend perspective, with its current dividend yield seems to be attractive at the moment. And the amount of dividends that it's being paid out right now, I believe, is only equating around 40% of its current free cash flows, which I don't see out any problems of the company paying these out in the coming years. Now, let's have a look at the next company in this list. It is Regeneron Pharmaceuticals, ticker symbol REGN. Regeneron is developing a single treatment consisting of 2 antibodies. The company thinks that the cocktail may both cure and prevent the CVPD. It is looking to release data on the antibodies by the end of September. On its earnings conference call, Regeneron Chief Science Officer George Yanakopoulos named that in the lab studies, the antibodies thwarted the virus spike protein. The double antibody approach prevents the virus from overcoming the impact of a single antibody through mutation, he explained. Yanakopoulos also noted that in monkeys, the antibodies were able to prevent the CVPD infection as effectively as vaccines. In addition to the positive preclinical data, there are 2 other reasons to be optimistic on Regeneron's antibodies. First, the company was previously able to develop antibodies that effectively treat the Ebola virus. Second, the federal government has already signed a $450 million contract with Regeneron to manufacture and supply antibodies. Although the deal appears to be contingent on emergency approval by the FDA, the fact that the government is willing to invest a meaningful amount of money in manufacturing the drug after it is approved indicates that Washington has significant confidence in Regeneron. Okay, ticker symbol for Regeneron is REGN. Looking at the price to earnings ratio, it definitely is at a discount when compared to the S&P 500 index. Now let's see if Regeneron meets our dividend portfolio. REGN, since it doesn't pay out any dividends, can be a part of this portfolio, but let's see in terms of a value perspective. REGN, 21.32%, so definitely return on invested capital is pretty positive, and the free cash flows have been increasing consistently from a negative to a positive. It currently has $2 billion right now. So net cash flows definitely a positive. Strong balance sheet, $1.5 billion, which it can easily clear off with its total current assets of $7.86 billion. Now let's calculate the earnings per share. It currently has $25.83 earnings per share, REGN, and has been trading at a range of 14.18 and 136.38. And the analysts are estimating that the company can grow at around 12.18%. And this brings our fair value to intrinsic value to $1,770, and the fair price at which we should be buying the stock is going to be somewhere around $402.58. Looking at the current valuations, I would consider REGN stock as a part of weight criteria, because it might, if the company does fall around $400 or at least the $500 range, we can consider buying the stock because of its current return on invested capital levels, which is more than 20%. And the last that I could see, it was somewhere around negative, but that we can see that the company has been performing lately pretty good in the past 5 years with its return on invested capital. Now, coming to the last company in this list is Sorrento Therapeutics. Sorrento has many shots on goal when it comes to combating the CVPD. The company has a test, multiple therapies, and a vaccine candidate. By far the most promising area in its quiver is the CVPD test it brought from Columbia University. As I explained in the previous column, the test, which evaluates saliva, does not require laboratory lab equipment or a health professional. Importantly, it generates results within 30 minutes. Consecutively, the diagnostic, which may cost only $10, should be cheap and relatively fast alternative for many businesses, hospitals, and schools. Recently, a compelling test for Abbott Laboratories, ticker symbol ABT, received a great deal of publicity. I pointed out, however, the test is more invasive. Although it yields results in 15 minutes, it requires a nasal swab, making it quite uncomfortable. Further, since a medical professional has to administer the test, I believe that it will be much more expensive. The rival test for Sorrento seems simple enough for use by those without medical backgrounds. Another positive, Sorrento's test also helps identify those who have the virus but are asymptomatic. And as I've noted previously, I believe that the company's CVPD treatments could generate significant revenue in the future, while its recent merger with Smart Farm is also likely to boost Sorrento's shares in the long term. Now let's have a look at Sorrento Pharmaceuticals, SRNE. It doesn't have a positive price to earnings ratio. That's why it's coming up as NA. SRNE. Let's see if the company does meet our dividend portfolio. The free cash flows are negative. As a result, we wouldn't be considering this company as a dividend portfolio, as it doesn't pay out and it doesn't have any future cash flows. As a result, we wouldn't be considering this company as a part of our dividend portfolio or our value portfolio. So out of all these four stocks, these are the two stocks that I've came up to a conclusion which seems to be really attractive. That's the one with GILD, which you can buy in terms of a dividend perspective, and REGN. I would consider waiting so that it can come down to around a $400 range before investing in this company, or at least a $500 range, right? And the closing remarks for this article is, on the date of the publication, Larry Rammer held a long position in WST, GILD, and SRNE. Larry has conducted research and written articles on the US stocks for 13 years. He has been employed by The Fly and Israel's largest newspaper, Globes. Among his successful contrarian picks have been Solar Stocks, Roku, and Snap. You can reach him on StockTwits at Larry Rammer. Larry began writing columns for the Investor Place back in 2015. So if you guys have stayed around till this part of the video, I really appreciate it, guys, and I don't take this for granted. Thank you so much for the hardcore fans out there. So full disclosure, this video is for your education and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques and ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So if you guys want to stay tuned with all the latest articles, make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos. Until next time, See you in the next video. Peace.